Okay, the next one on our list is E66. E66 gives us some information about a company. The information included here is the bank statement and the T account for the cash that the company has recorded. Remember, the T account is the summarization process where we take all the journal entries that we've made and put them into a format that looks like a T, like this. So cash is listed out here, right? And it increases on the debit side and decreases on the credit side. So if this is your records of what's in your book, if the cash account is the records of what's in your book, a debit on the left-hand side of the cash account, a debit would increase it. We could think of those debits like deposits, okay? And on the right-hand side, a credit would decrease that. So we could think of the credits as in checks, right? So the point of this problem is it asks us to do a bank reconciliation, which is a comparison of the bank statement to the company's books. The easiest way to do this, since they give us the bank statement and then they give us all of the entries to the cash account, is to start comparing the two. First thing that we should do is look at the cash T account and scroll the left-hand side and determine what deposits are in the cash account that are not in the bank statement. So if we do that, looking on the left-hand side, we have in the cash account $3,000. $3,000, that shows up in the bank statement. So that one's good. If we look at September 30th, $2,500, $2,500 does not show up in the bank statement. $2,500 must be a deposit in transit. Why? Because $2,500 showed up in the cash account but did not show up in the bank statement. So we must have deposited it in the cash account, but it is not yet cleared in the bank statement. Okay? Next thing we want to do is look to the opposite side, to the credit side. If we look at the cash T account on the credit side, we can scroll down those checks. We see that they're all checks because they all have check numbers next to them. Until we get to check number 104. Check number 104 for $50 did not clear. $50. So it is considered an outstanding check. Why? It is included in the cash books, the cash T account, as a credit. But it has not yet been presented to the bank. So that means it's not included in the bank statement. Now what are we missing here? We've done the deposit in transit, we've done the outstanding check. Well, to get to this balance that I've showed that's calculated here, we need to include the opening balance. To find the opening balance here, we start with the last day of the month on the bank statement. So if we go all the way to the left-hand side on the bank statement, we see September 30th. The September 30th balance, if you look to the far right of the bank statement, you'll see is $230. Notice that that balance is a running tally. It changes every time a new line item on the bank statement shows up. Okay? So when we calculate out this, we get the adjusted balance here of $2,680. This side is adjusted because it doesn't tell us anything about errors. And remember, the three things that you could adjust the bank statement side for was deposits and transits, checks, and errors. Okay, so this side must be adjusted. Now let's go to the company. For the company side, to look for adjustments, we go the opposite direction. We start with the bank statement and look at the T account and ask ourselves, what is missing? If we look at the bank statement, the first thing that we see here is an NSF check. An NSF check for $100 did not show up on our T account. So we need to write that as a reconciling item. So $100 here as a subtraction. Remember, NSF checks indicate that we received a check, so we recorded it as cash. Turns out when the bank checked on it for us, turns out there wasn't enough money to pay it. Therefore, we need to reduce it or take it out of our cash balance. Okay? Reestablish AR. Remember, NSF checks are not checks that the company wrote. They are instead checks that the company received from customers. Okay? Again, scrolling the bank statement, if we look, The next thing that shows up that did not show up on our T account is EFT deposit. EFT deposit of 150 here is an addition. Remember, the EFT deposit is like when money goes into our account, someone directly deposits it into our account, but we don't know about it. When do we find out? When we see the bank statement. So we're adding it to our cash account here, okay? Because we've not yet found out about it until we saw the bank statement. The bank obviously knows about it. They created the bank statement, okay? Continue scrolling on the bank statement here. The next one shows up as a service charge. Service charge, we also did not know about. $20. That's going to be a reduction in our, as an adjustment, a reduction adjustment, okay, in our company side. So, what are we missing here to get to this 2,680? Because obviously this doesn't balance here. We need to add the beginning balance. The beginning balance that we start with is actually the ending balance for that month. So where was the starting point here? This 2,650 was our beginning balance. Notice when we use the word beginning and we're talking about a bank reconciliation, what we're asking ourselves is, where is our starting point for the comparison? The comparison is done at the end of the month. So our starting point is at the end of the month. Where do the balances start at when we're trying to compare them? Not where did they start at the beginning of the year. That's not what we're asking here. We're asking, where did they start at when we're trying to compare them? When are we trying to compare them? As of or at this date here. Okay? All right, so when we do this, we see that 2,680 equals 2,680. The next part of the problem asks us to do the journal entries. Notice that in bank reconciliations, we only do journal entries for the company side. So, if you look over here, when we receive the EFT, right, we debit cash because we've got it. We didn't know about it until the bank told us, but now we increased our cash account. Decrease accounts receivable. Someone owed us this money. That's why they're paying us. It's not just good fortune, okay? So we need to decrease our accounts receivable once we find out who it is. The next one, NSF service charge. If we look at this one goes over here. Notice we're decreasing our cash account. Originally we received the check, turned out to be no good. When we received the check though, we increased cash, decreased AR, because we said they no longer owe us. They just paid us. They wrote us a check. But when we find out the check is no good, we reverse that. So we reestablish AR. You still owe us money, your check did not clear. And then we decrease cash because we previously increased it. And the last one here, service charge. Service charge would go to something like an office expense or bank expense, bank fee expense, miscellaneous expense. Really the point is, and usually these are pretty small, it's just some sort of expense. Miscellaneous expense, office expense, bank fee expense, bank service charge. Anything like that will be a correct account. Okay? But it needs to show up as an expense. It goes on the income statement as a reduction of net income. Okay? And then we paid cash for it. Obviously the bank took the money out of our account, so we credit cash. The last two parts of the problem, part 3 says, what should the balance in the cash account be after recording the journal entries? Well, obviously, if we do all of these adjustments and we start with this and we do all 3 of these adjustments, we're going to end with this guy. The ending adjusted balance, 2,680. We do not adjust for the bank statement side. We don't own the bank. We don't mess with their books. Anything that they need to do, they'll correct themselves when the checks are presented or processed, right? But we adjust for our company side, okay? The last part of the problem says if the company also has $400 of cash on hand recorded in a separate account, what should the total of cash be that shows up on the balance sheet? In this instance, we add the two together. Remember the concept we talked about in class, cash and cash equivalents. When you see the line item cash on a financial statement, on the balance sheet, they're talking about all bank accounts that the company has. All petty cash accounts. Cash that they have in a locked drawer. Coins that they have. Checks that they have. Okay? Cash and cash equivalents. Don't forget, cash equivalents are highly liquid securities that they have that mature so quickly their value's not going to change. So those are also considered cash. Usually the threshold of time for that is 3 months if they mature within 3 months. All right, this is E66. Please send me any questions.